Well, forget fears of a bubble. The housing market is in its best shape since 2001. That is according to Nationwide Insurance. They nixed concerns of a national downturn, instead saying that growth is going to be steady and sustainable over the next few years. They also outlined the best and worst markets right now, making the top 5. Pittsburgh, Cleveland, Philadelphia, my hometown. Down at the bottom, Atlantic City, New Orleans, and Bismarck, North Dakota. You can probably guess why. Bismarck. Well, I want to bring in my guest host, Don Peebles. He's the chairman and CEO, as I mentioned, of Peebles Corporation, the multi-billion-dollar real estate developer. So, Don, all of that is consistent with some of what you're seeing through your business, right?
Yes, absolutely. In fact, we're doing a new hotel in Philadelphia right now. And I think you look at those cities, at the top 5 cities, those are the ones that were coming out of the recession later, major cities that were coming out later. And then you see the bottom 5 are the ones that are struggling for fundamental reasons.
So if you live in New York and Miami, you get a skewed view that we're in a housing bubble because they are so separate from what's going on in the rest of the country?
Yeah, I think so. Well, the demand...
And San Francisco, I got to throw that in there.
Yeah, I would say San Francisco. Look, San Francisco has a shortage in terms of housing keeping pace with its natural growth in population. The growth in population, say it's about 40,000 new residents, and during the time period, they've only increased housing supply by 7,500, so there's an imbalance. New York City is an amplified imbalance. So the imbalance between supply and demand is what creates such strength in a New York City market.
But isn't that a good problem? Doesn't San Francisco have don't they have a high-end problem now?
Well, San Francisco's problem is that only 40% of the median income households can afford to live in San Francisco. So basically what you're having now is a shrinking population that can stay in San Francisco. So the middle class is being pushed out of San Francisco to the East Bay. So it's good for the region because San Francisco is a supply-constrained market. It's a very small city, relatively speaking.
You can see it spreading out.
Oh, yes.
So are you looking? So are you going to look for opportunity there?
Yeah, we've developed in San Francisco in the past, and we're looking in the East Bay, for example. Oakland, I think, is a great environment, and Berkeley. You know, you've got a tremendously educated workforce there. So I see there's, on the commercial real estate side, you're going to see the East Bay pick up as well because San Francisco's so expensive as well.
Last year, so many property developers were on this program saying Miami is the hot place to be. You've got to go down there, Betty. You need to move down there. It's fantastic. And the property prices are going up and up and up. But that's not the case anymore, is it?
No, look, I think Miami's a wonderful city because it's got great climate and it's a unique, culturally diverse community. And so it's an outstanding place to live and visit. In terms of real estate, it has some fundamental flaws. It is a vacation-oriented market. It's a leisure-oriented market. And so the vast majority of the multifamily buyers of condo units, tend to buy vacation homes. And 70% of those buyers are foreign buyers. So 70% of the market for pre-sale construction in Miami are foreign. For condos, yes.
Okay.
And what's happened is that you had this, you know, when the recession came, the faucet was turned off in Miami very quickly and very tightly. So there's been no real new supply for many, many years. So from, say, 2008 to 2013, there was nothing new coming online.
Nobody could get a loan.
But now, Florida actually is a very unique place in that regard, too, because no one could get a loan, but now the condos that are being built are financed with buyer deposits. So think about this. The typical buyer puts down 50% of the purchase price, and the developer can actually use 40 out of that 50% of those deposits for constructions to build a place. So in essence,
I love that.
So in essence, the buyer is an investor taking an unsecured investor in the development of condos in Florida with no security and no real underwriting of the developer. And so if anything goes wrong, they lose their deposits.
They lose their deposits. So it's like, I promise to build you this, just give me the money.
Right. And even so a typical construction loan, say in New York City, between senior and junior debt is going to be about 80% of the total project cost. In Florida, the debt is about 40%. And even then, it's a heavier lift to get projects financed because the financial markets don't believe in the long-term stability of Florida because it's so volatile. Because when a recession hits or a currency crisis takes place, boom, there's no need to buy a vacation home.